The $1 trillion semiconductor evaporation. Within a span of less than 30 days, the tech-fueled euphoria that defined the first half of the year has transitioned into a systematic, orderly, yet brutal liquidation. Wall Street has just witnessed over $1 trillion in market capitalization evaporate from the semiconductor and hardware sectors. To understand the scale of this drawdown, we must look beyond individual stock narratives and dissect the structural plumbing of the market. Even Taiwan's Semiconductor Manufacturing Company, TSM, despite posting blowout quarterly earnings that beat both top and bottom line institutional consensus, could not find buyers to support its valuation. When stellar earnings reports are met with aggressive selling volume, it is a textbook signal of distribution. Large institutional players are using high liquidity events, like earnings beats, to exit massive positions to retail buyers who are still operating on backward-looking narratives. The macro regime has shifted from buy the dip to sell the rip. The South Korean fuse and Asia's systemic leverage trap. While domestic retail traders in the United States focus strictly on Federal Reserve policy, the actual catalyst for this global margin unwind originated in East Asia, specifically South Korea and Hong Kong. A dangerous structural anomaly developed over the last year in South Korea. Retail investors, seeking to maximize returns, began liquidating their traditional conservative retirement portfolios, the equivalent of US 401ks or Australian superannuation funds, to purchase double-leveraged, 2x, single-stock ETFs tied to high-beta semiconductor names like SK Hynix and Samsung. In Hong Kong, the single largest ETF by assets under management, AUM, became a 2x levered vehicle tracking SK Hynix. This hyper-concentration of retail leverage created a systemic vulnerability. At the first sign of a cyclical slowdown in DRAM contract pricing, these leveraged vehicles faced massive redemptions. Because these ETFs hold derivative contracts and swap agreements, market makers were forced to dump underlying shares to maintain delta neutrality. This panic reached such a pitch that South Korean regulators took the historic step of temporarily banning all new single-stock leveraged ETFs. Over 1.2 million accounts were identified as carrying significant leverage risk, with over 360,000 accounts experiencing forced liquidation in a single week. When Asia liquidates its tech holdings to cover margin calls, those sell orders route directly into the US pre-market, driving down companies like Micron, Applied Materials, and Nvidia. SpaceX and the post-IPO Reality Check. The sentiment shift has also penetrated the private-turned-public megacap space. SpaceX, which recently made its highly anticipated public debut, has officially broken below its initial public offering, IPO, price of $127. The trigger for the initial breakdown was the first post-IPO test flight of the Starship vehicle. An unexpected ignition failure occurred during the hot staging sequence. While development programs naturally anticipate anomalies, the public nature of Elon Musk's live updates on X, formerly Twitter, acted as a real-time sentiment machine. Historical analysis of high-profile unicorn IPOs reveals a sobering statistic. Data compiled by Astra Insights shows that when a highly anticipated growth stock breaks below its IPO price within the first 60 days, only 36% of these stocks manage to reclaim and hold their IPO price 3 weeks later. The remaining 64% enter a prolonged phase of accumulation, often trading sideways to down for 6 to 18 months, reminiscent of the Meta/Facebook or Coinbase post-IPO cycles. Broken IPOs lack a historical cost basis support zone below them. Every investor who bought the launch is now in a losing position, creating a heavy overhead supply of sellers looking to get back to even. Bubble searches, Hindenburg Omens, and volatility clusters. A common maxim on Wall Street is that bubbles do not pop when everyone is talking about them. But current quantitative indicators suggest we are testing the limits of this rule. In June, public searches for stock market bubble and
AI bubble, reached their absolute maximum value of 100 on Google Trends, eclipsing the previous local sentiment peak of August 2025. While this public anxiety typically suggests a contrarian bullish signal, the underlying market structure is flashing rare warning signs. First, we are seeing high cluster volatility near all-time highs. Specifically, back-to-back days of plus or minus 3% moves in the Philadelphia Semiconductor Index, SOX. Historically, this behavior is not characteristic of a healthy bull market. It is indicative of institutional distribution. Second, we have registered 16 distinct Hindenburg Omens signals within a tight window. This technical indicator triggers when the market shows an abnormal number
of both new 52-week highs and new 52-week lows simultaneously, alongside a decelerating McClellan oscillator. It indicates a deeply fractured market, where only a handful of megacaps are holding up the index, while the average stock is quietly declining. Macro divergences, the carry trade and debt creation. To understand why the broader S&P 500 has not completely collapsed despite the semiconductor rout, we must analyze the profound divergences occurring across commodities and foreign exchange markets. Copper has embarked on an aggressive upward trajectory. Because copper is the primary physical input for electrical grid modernization, AI data center power delivery, and global electrification, its price action suggests that physical GDP growth and industrial debt creation are still actively expanding. Gold and silver, conversely, are experiencing capital outflows. Silver ETFs have experienced a near-total collapse in inflows. This tells us that while financial assets are experiencing high volatility, the market is not yet pricing in a systemic deflationary depression or an immediate Fed capitulation. The most critical macro variable is the Japanese yen, JPY, which has weakened to 162 against the US dollar. This extreme level puts immense pressure on the Bank of Japan, BOJ, to intervene or hike interest rates. A strengthening JPY threatens the global carry trade, where institutions borrow cheap yen to buy high-yielding US tech assets. If the yen rapidly unwinds, institutions must liquidate their most liquid US assets, namely semiconductors, to repay JPY-denominated debt. The under-the-hood rotation. Is this the beginning of a multi-year bear market, or is it a violent sector rotation? The internal data points heavily to rotation. While semiconductors have been decimated, other sectors are quietly demonstrating remarkable strength. Regional banks, KRE, rather than breaking down as they would during a systemic banking crisis, have broken out to new local highs, up 2.82% in recent sessions. The equal-weighted S&P 500, RSP, continues to hold its daily 20-period moving average. This proves that the median stock in the S&P 500 is actually stable or rising, even as the market cap-weighted indices suffer from the tech drag. Furthermore, defensive sectors like healthcare, XLV, are printing bullish island reversals, while consumer staples, XLP, are consolidating for a potential relative breakout. Wall Street is not exiting equities entirely. They are shifting capital from high beta AI speculation into low beta, cash flow rich defensive value. The NASDAQ put wall and the waterfall danger zone. As we head into the weekly close, all eyes are on the options market structure for the NASDAQ 100, NDX. This is where the battle between buyers and sellers will be mathematically decided. The put wall is currently established at the 700 level, with a secondary support zone at 695. Options market makers who sold these puts are long gamma. As long as the price stays above 700, they must buy futures contracts as the index dips to keep their books delta neutral, creating a natural floor or support zone. The waterfall risk begins if the Nasdaq breaks and closes decisively below 695. Those market makers instantly transition into a short gamma regime. To hedge their exposure, they must sell Nasdaq futures as the market falls. This mechanical selling feedback loop is what creates a waterfall effect, a rapid, panic-driven slide toward the next major liquidity pocket at 650. Technical execution and the reaction rule. For educators and disciplined market participants, this environment requires a strict adherence to rules over emotions. Let us look at Netflix, NFLX. The stock topped out back in 2025 and has consistently printed lower highs and lower lows, recently sliding another 9% in extended hours trading down to the $67 level. Many retail traders attempt to catch the falling knife by buying Netflix or semiconductor stocks simply because they are cheap relative to their peaks. This is predictive trading, and it is a statistical path to ruin. Instead, professional risk management dictates waiting for a V recovery or structural shift. First, identify the demand zone near historical institutional volume blocks, such as the $61 demand level for Netflix. Do not buy the first touch of the level. Instead, observe the reaction. Wait for buyers to step in and drive the price back above a previous minor swing high on high volume. Finally, execute with a defined risk, placing your stop loss strictly below the confirmed swing low. This ensures that even if you are wrong, your loss is mathematically capped, while your upside remains open. Control your parameters, manage your size, and let the market reveal its hand first.